Shell stock is up nearly 21% over the past year, and when you compare that to the broader market as a whole over that same time period, this is a stock that's performed extremely well. You won't find many stocks with that great of a return in that same time period. Now, obviously, this is a company that has reaped the benefits of decade-high oil prices, but they are starting to get a lot more institutional interest as well. We can see companies like JP Morgan and Morgan Stanley have been raising their price objectives for the shares of this company. So in this video, we're going to be jumping into my stock valuation spreadsheet where we can find the intrinsic value of Shell and decide if it's a stock we should be buying or selling. Now on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, and a multiples valuation model, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and we'll come up here and we're going to plug in Shell stock ticker, SHEL, and hit enter. And we can see all of this data is going to automatically load in. Now we're currently looking at a 365-day chart, so we can see a huge run up in the stock price. But let's go ahead and zoom in a little bit more and look at a 250-day chart. And we can see we have seen quite a decline here. And what we're hoping is this is going to lead to a buying opportunity. But let's go ahead and look at some of the metrics here. The dividend data over here, paying out $1.94 per share, which gives them a dividend yield of almost 4%. That's a pretty high dividend yield. I love to see companies paying out that high, which is one of the benefits of the current market downturn. Now the payout ratio is currently sitting at about 34.6%, which is a pretty nice low payout ratio. Now the 20, 50, and 200-day moving averages are all down slightly, obviously due to this recent decline that we have seen, but the 1-year return is still at 21% and 2-year return a massive 52.2%. Analysts currently have a target price of almost $70 per share. Now institutional ownership is a little bit low for this company, but like I said, they are starting to get more interest from a lot of institutions. The beta is only 0.7, so you're going to see a lot less volatility in a company like this. But let's go ahead and look at our first valuation model, which is Graham's valuation. And this is a valuation model invented by Benjamin Graham. Let's go ahead and zoom over here, and we can see the formula he laid out for us to calculate intrinsic value right here. So the first thing we're going to take is the earnings per share. We're then going to multiply that by 7 and apply a growth rate, which is a pretty low growth rate, but we're applying a growth rate of about 1.5 moving forward because of analyst projections and industry expectations. We're then going to multiply that by 4.4, which is the average yield of AAA corporate bonds. And once we have that number, we divide it by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it's currently sitting at 4.2. It's continuing to go higher and higher. Now, we do need to keep in mind, early this year, it was as low as 2.8. So if it were to be 2.8 right now, we can see the intrinsic value would be about $74 per share. Because this has risen so much at 4.2, the intrinsic value is a lot closer to about $50 per share according to Graham's valuation. But let's go ahead and jump over to our discounted cash flow model here. And on our discounted cash flow model, we want to apply a growth rate to the future free cash flows for this company. So what I've done is I've plugged in the historical free cash flows here, and we can see they have had an average growth rate of about 25.12%. Now, obviously, that's not going to last. They've had a really choppy free cash flow. We can see a huge year here of 45%, then 2 negative years actually right here, and then a huge jump from 2020 to 2021. But moving forward, after looking into the industry expectations and again, analysts' projections, I'm applying a growth rate of about 2% for the future free cash flows for the company. So I use that growth rate to project the future free cash flows and the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of these future free cash flows and added them together, which you can see right here. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. I then divided by the number of shares outstanding to find our discounted cash flow price per share of $75 per share, which is actually pretty close to what analysts' current target price for this company is, which you can see right here. But let's go ahead and look at our multiples valuation. And I really like the multiples valuation model for this company because I think it provides a pretty fair valuation. And what this is going to do is we're going to look at companies that are similar to Shell in structure and in size. So we're looking at companies like ExxonMobil and Chevron. We're taking their stock price and dividing by their earnings per share to see what their price to earnings multiple is. We then take the average price to earnings multiple and multiply it by Shell's earnings per share to come to an intrinsic value of 77.3. Now, obviously, this is not how high Shell is trading currently, which means their price to earnings multiple is much lower than companies that are in the same industry as them, which may mean this is a buying opportunity. But let's go ahead and look at our dividend discount model now. And in order to perform our dividend discount model, we want to look at how much this company is paying out in dividends and how much they're going to increase their dividend payouts in the future. So what I did is I plugged in the historical dividend payouts for this company quarterly so I can see how much they pay out each year, and this allows me to see the growth rate year over year. Now when we look at this yearly dividend payout, we can see there was a huge decline from 3 years ago to 2 years ago. So that is a major red flag for this company. We can see it was almost a 66% decrease in the amount they were paying out in dividends. Now since then they have increased it a little bit. You can see 8.44% here and 44% here, but still this is a major red flag and something you have to take note of. This is not a company that has been consistently raising the amount they pay in dividends. In fact, it has actually been the opposite. They've had an average growth rate of negative 3.36% over the same time period, but because of this they do have a much lower payout ratio now, which is good for the health of the company long term obviously, and the ability to continue increasing the amount they pay in dividends in the future. But because of this I can't apply a high growth rate. There's just too much uncertainty regarding this dividend. So I'm applying a growth rate of about 3%. After applying a discount rate of about 8.5%, we can see our dividend discount model gives us a price per share of $37.45 per share. But let's go ahead and jump over to our output tab. And here on our output tab, we have all 4 of our valuations. We have Graham's valuation at almost $50, multiples at 77, discounted cash flow at 75, and our dividend discount model at $37.45 per share. Now, when we average all 4 of these together, we can see we come to an intrinsic value of right at $60 per share. Now, the current price of this company is currently $49 per share, but we always want to apply a margin of safety as value dividend investors. So for example, let's say we want to apply a 30% margin of safety and hit enter. We can see based off of this, our acceptable buy price for this company is $42 per share. So our spreadsheet is telling us this is not a stock we should be buying. But if our margin of safety was 20% and we were a little bit more aggressive, we can see based off of this, our acceptable buy price is $47.99 per share, which is still not a buy, but it's getting very close to that buying territory. So as for me personally, this is a stock currently on my watch list. I don't own any shares in my portfolio currently, but it is starting to get very close to that acceptable buy price, whether you're in the 20% margin of safety or 30% margin of safety area. I like the dividend payout and the dividend yield currently. I think that's great. Again, we do need to take note of this huge red flag of a huge dividend increase, but hopefully that will allow them to continue to increase the overall business as a whole and give them the ability to increase the amount they pay in dividends in the future. So again, as for me, it's going to be on my watch list, but I do not currently own any shares. But go ahead and let me know what you think of this company in the comments below. If you'd like to be able to download the spreadsheet, then go ahead and head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.